Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Scott Nations, president of Nations Indexes, as well as Mark Sebastian, CEO of Option Pit. We're here to discuss what could be the catalyst to another leg up in the market. It is great to see the both of you, as always. And Mark, let's kick it off with you. And you're taking a look at the small caps. Feels as if the small caps over the past few years, they ready, set, go, and then there's no follow through. You think there's something here?
Absolutely. The Nasdaq 100, the QQQ is up over 17%. The S&P 500 is up 14%, and the Dow, the slowest moving, is up over 10% year over year. You go back and look at this, the Russell 2000, it's up a tiny 1.3%. If there is going to be a second leg up, small caps need to play some catch up. Now, are they going to get up to 17% on the year? Probably not. But could I see some near-term outperformance there? Absolutely. Just getting to its recent highs would mean another 10, 15% higher. I like the IWM up to about 240, 245, somewhere in that range. If it's going to get somewhere in the ballpark of where the rest of the major indexes are.
Yeah. And Scott, you noted that the bond vigilantes haven't necessarily acted as perhaps you thought they might have as it relates to the market activity we're seeing and, of course, taking advantage of some things and the big, beautiful bill.
That's right. The big, beautiful bill you would think would be horrible for bond prices because by every metric, it increases the debt and the deficit at least over the next 2 or 3 years. We already have an enormous federal debt, and this would only make borrowing conditions even tighter. That is, you would think it would raise interest rates at least over the next 2 or 3 years. But bond prices doing very well today. Treasury bonds up a point. 10-year Treasury notes, the yield there is down 7 basis points. If we look at the futures over the last 52 weeks, the movement's not very impressive. We're back to the middle of the 52-week range, as you can see. But that means that we can move either direction from here. I thought bond vigilantes would be in the market by now. That is, traders who either sell or short bonds because they're unhappy with fiscal policy. I would have thought that they'd be in the market in droves right now, and that's certainly not the case. Those that are in are getting their heads handed to them today. So this is pretty impressive. And if rates do continue to lower a little bit, then that's going to be good for equity prices.
Yeah. Well, certainly, Mark, if you do get a cut in rates, the small caps have been waiting for that for quite some time. That'll be a huge catalyst for them if that's not priced in at this point.
No, it's not. So if rates do pull back, and we've got the Fed meeting coming up at the end of the month, I think they're going to tip their hat on what they've got planned. If rates do look like they're going to start coming in, then that is going to be a huge catalyst for the Russell 2000. Now, one thing that's curious about the bond market right now is, the treasuries are definitely off since April when we had the tariff tantrum and everything along those lines. But we've seen real resilience among both investment grade and junk debt, which you would think at a minimum junk debt would start pulling back if with the sell-off that we'd seen in the bond market, and they have not. So makes you wonder whether whether there's going to be some sort of equilibrium here, and we're going to see U.S. Treasury start to rally. Makes me also wonder, how much of this stimulus was priced in when they started selling off in April.
Scott, though, is a rate cut necessarily warranted at this point, though? Some of the data and the way that labor market is acting, or the way that the consumer is holding up, perhaps inflation's somewhat in line, right? Is it necessarily warranted, I think, is the question.
I think there are 2 reasons we are not going to get a rate cut this year. One is because it's not deserved. Year over year CPI increasing 2.7%, so it's still quite a bit higher than the Fed's 2% target. In addition, if you were Jerome Powell and you knew that the administration was trying to pillory you into cutting rates for purely political reasons, because there's nothing that suggests that rates should be lower from a macro or fundamental point of view, then aren't you going to dig in your heels? You know you're out of a job next year. Aren't you going to dig in your heels, stand up for the independence of the Federal Reserve, do the next chair a huge favor, and stand up and say, nope, not going to cut rates. It's not deserved. And the names calling for a rate cut are doing it for purely political reasons. I think two reasons that we will not see rate cuts. And let's also face it, Jerome Powell has zero reason to do this administration any favors.
Yeah, that's an interesting point that you bring up. So, Mark, it makes you wonder what is propping the market up here. Is it, I mean, earnings season's still, relatively in its infancy. Earnings have been quite good. Perhaps it's, just solidly on company fundamentals. But then the other question to that is, do you have to be super solid this quarter, or are you getting a pass just because there's some uncertainty out there? We don't have a clear read through as it relates to tariffs.
Well, I think it kind of depends where you are, what business you're in, where you are. Mm-hmm. If you're one of the giant mega caps, you're an NVIDIA, you're an Apple, you're a Google and Tesla who have earnings this week, your earnings need to be not just good, not just great, they need to be perfect. You need to be raising guidance above what's expected. You need to come in ahead. Then that's going to give you a lift. However, while the market is at an all-time high, how many of the 500 stocks that make up the S&P 500 are at an all-time high? And the answer is less than half, really less than 80% of them are at all-time highs. And the reason being is that this has been so mega cap led on the rally. So it really depends. If you're in one of the major players, then yeah, you need to come in perfect. If you're one of the high beta stocks that has caught this huge AI lift, like a Palantir, your earnings are going to need to be perfect. However, if we see some positive guidance out of some of the smaller AI names, those names will do really well if their earnings are just good. So this earnings season is going to be interesting. You just have to be real careful around those mega caps that are sitting at or near all-time highs heading into their earnings. Their earnings aren't perfect. They're probably going to get punished, much like JP Morgan was last week.
Yeah. And Scott, that's really what the challenge is, because even if you do see a broadening out of breadth within the small caps, the mega caps have such significant weightings in some of these indexes that it's just going to bring it down by the virtue of how important they are to the benchmarks.
That's right. And NVIDIA's led the way, closed last week with a market cap $4.2 trillion, only name with a market cap above $4 trillion. And so it has certainly led the way. Why haven't small caps participated? I think much of it has to do with the fact that they're seen as less resilient, less able to shoulder the burdens of tariffs if we end up in some sort of prolonged tariff situation. And so I think that that's probably why we've seen the biggest names do so well. Also, this slow motion AI bubble is interesting to watch. I think that's why NVIDIA is doing so well. We see how much money Meta has announced that they're going to spend. So I think that what we're going to look for from the big tech names is how much money they expect to spend on AI over the next 12 months, or how much revenue they expect to get from AI over the next 12 months. I think that's going to be really important. If we'll remember, 2 cycles ago, Google announced how much money they were going to spend on AI, and it shocked everybody. And now you have a great name like Google trading at a forward PE of less than 19.
Yeah, Scott, it was really interesting. From 2020 from 2000 to 2020, the mega caps cap expenditures was about $2 trillion. They've already spent $1 trillion in the last 4 years digging into AI. And some of the announcements, 75 million from Amazon, 75 billion from Amazon, 65 billion from Meta, 100 billion with the partnership between BlackRock and Microsoft. It is astounding the amount of money that they are racing to invest into artificial intelligence. And so at this point, you got to look, they're spending that much. Who are the ancillary winners that are not, the ones actually doing the spending? Who's going to come out of those winners? And there are a lot of interesting names starting to pop up that could do really, really well as AI goes from building out infrastructure, building out these data centers into actual use cases and actual usage of artificial intelligence. That's kind of the next wave, and I want to see if that develops.
Yeah, and Scott, that's an excellent point that Mark makes, because that's a question that we've been asking for the past 2.5 years. Who are going to be the derivatives of this AI trade? It's not simply just going to be NVIDIA and a handful of mega cap names. Think of the possibilities in other sectors such as the industrials, utilities, energy. I mean, virtually every sector has some sort of story to tell as it relates to AI. I mean, everyone's models are being completely revised. It's not like your AI is your center of excellence anymore. It is, data and AI are the commodities these days. This is how people, companies' models are being changed.
Right. I know. Listen, everybody's using AI for some reason now. Unfortunately, some are just using it as the modern day Google. Some are using it in really sophisticated ways. Jill, I think the problem is that it's essentially impossible to know who are really going to be the AI winners a decade from now. If we think about the big winners, big names in 1999, it was names like Cisco and Yahoo and MySpace. And the first one is much smaller. The second one barely exists, and the third one is gone completely. So I would suggest not trying to pick names, but rather assemble a basket. If you want to invest in AI, assemble a basket of 15 of the best names in the space, and you'll end up doing pretty well over time.
Yeah. And well, Mark, it also goes back to the point that you made about CapEx spend from 2000 to 2020. And this is one of our favorite charts that the index team at Nasdaq likes to discuss, where the Nasdaq 100 names have invested so significantly into R&D, and you've seen how that has translated into growth and the performance of the index overall because of that investment. So to see the constituents still continue to and not cut back on CapEx. So to your point, listening, what is CapEx going to sound like? How is it going to translate into revenue? What's it going to sound like when they're discussing ROI on a number of these investments? From a fundamental perspective, when you're looking at those metrics, that could really set it up for the next 10 to 15 years, to Scott's point.
Yeah, well, one of the things to think about, and there is one area where I feel like that I have a really good idea on who's going to win. And it's the investment banks that are involved in IPOs and the exchanges that list all these IPOs. The ability of AI to clear out so much of the compliance and the deep dives that those investment banking teams need to do is going to save Goldman, JP Morgan, Morgan Stanley, the heavy investment banks, lots and lots of money, because they're going to be able to use fewer people, get the research done faster, and get these IPOs to market much quicker. And of course, it's a win for the exchanges, because the more IPOs they get, the more trading, the better those exchanges do. Without naming any specific exchanges,
I was going to say our listings team would.
I'm not going to. I don't want to. We're on a specific exchanges network, and yeah. Just the entire group as a whole, right, I think is a big beneficiary. But watch those investment banks and then the second tier banks as well. The big, we've seen a nice run in Goldman and JP Morgan. I would take a look at that next tier down, the ones that are still doing some really decent sized investment banking, but are a little bit smaller and maybe haven't gotten as big of a lift. Truist, Fifth Third Bank, some of those names could be winners, along with Wells Fargo, who's now finally allowed to grow. Let's see what they're able to do with AI as well.
Yeah, I would also argue, obviously, the semis we spoke about before, but so the cybersecurity space within the Nasdaq 100 has outperformed the index for these reasons, because the more tech you add to the stack, the bigger your attack surfaces get, and so the need for cybersecurity and continuous compliance, which agentic AI will allow to happen, right? So it's you are starting to see some of these derivative plays take place because of the opportunities that AI is opening up. Yeah.
Absolutely.
Right. Well, we shall see where the chips fall in the next 3, 5, 10 years. Appreciate your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.